So, welcome everyone. My name's Kevin Watkins. I'm director at ODI, and I'd like to welcome all of you to this evening's event, Brexit Impact on Developing Countries. We've had an awful lot of discussion about Brexit, not quite so much discussion about the potential implications for people around the world, and in particular in developing countries. As well as those of you in this room, we have around 200 people who are joining us online. So welcome to our online audience. For those of you who are on Twitter, the hashtag is GlobalDevBrexit. We have a fantastic group of speakers with us this evening. David Luke, who's coordinator of the Africa Trade Policy Centre in the UN Economic Commission for Africa. Welcome, David. Phyllis Papadavid, who's team leader in our international macroeconomics here at ODI. Vicky Price, who's economist and former joint head UK Government Economic Service, and Mohammed Razak, who's advisor and head of the International Trade and Regional Cooperation section at the Commonwealth Secretariat. It strikes me that the discussion around, or the fallout from the Brexit discussion, is a reminder of a few important home truths. And I'm going to try and be slightly bipartisan in the way that I present this. The first is that calamitous decisions do indeed produce calamitous economic consequences, ranging from what was the biggest one-day loss in a hard currency since the end of the Bretton Woods system, the biggest 10-day loss in the last quarter of a century. The Brexiteers have managed to achieve a drop in the value of sterling in one day, which was twice the amount that George Soros achieved with the gamble on sterling around the time of the exchange rate mechanism. So that's quite an achievement. It turns out that, whatever the failures of experts, they got that one right on this particular issue. The potential economic loss from the range of estimates that I've looked at are typically coming in at around 1% of GDP long term. To put that in context of a number that was widely used in the debate, the net contribution of the UK to the European Union is around 8.5 billion sterling. The loss associated with 1% of GDP is around 18 billion. So that turns out to be not such a good move either. I think also, and this really, to some degree, slipped under the radar until relatively recently, that, this is also a reminder of the reality of global economic interdependence, that we've had textile exporters in India and Bangladesh, fruit and vegetable exporters in Kenya, expressing really serious concerns about the implications for their prospects in the UK market. So some of the poorest countries are affected. We've seen central bank tightening in South Africa, Brazil, and other countries as a direct consequence. There are clearly huge ramifications for the value and effectiveness of the UK aid budget, all of which we're going to have an opportunity to discuss. So the way that we're going to run this is we're going to kick off with some questions from me to the speakers and some quite short responses. I'd like to make this, to the extent that we can, reasonably controversial and provocative, so please don't feel you need to hold back. And then we'll throw it open to wider discussion. So, David, let me kick off with you. I think in many respects, from those channels that I've been mentioning, the trade channel, the remittances, of course, there are huge consequences there, but also aid channels. This has very big consequences for Africa. I mean, maybe if you could start off by telling us something about, your perspective from the ECA and any preliminary work that you've been doing on that area.
Sure. Thank you, Kevin, and good evening to everyone. Truly delighted at this turnout. Yes, at the Africa Trade Policy Center, we did some quick and dirty estimates in the last few days as to what's the likely impact on Africa and the channels. And indeed, you've identified the key ones that we inevitably looked at: trade, investment, remittances, aid, as well as, of course, tourism, which is for several African countries, the UK share of the market is important. On trade, our estimate is that the UK accounts for about 11% of Africa's agricultural trade, which already you mentioned in relation to small producers and so on, and about 14% of non-agricultural trade. Within that 14%, of course, a large chunk is petroleum products as well as mineral products from the leading petroleum and mineral exporters. So we do see some risks if the UK economy slides into a recession for this relationship, and also depending too on the depth of the recession and the length of the recession. So we do see some risks on that front. Very quickly on investment, the UK's investment between 2004 and 2014 has actually doubled from about 20 billion pounds to about 40 billion pounds, and some of this is beginning to go into sectors that we see as growth pools for African economies. Again, we see a risk there. I know we'll be talking a lot about aid, but I'll just very quickly say that on the aid front, it's not only, again, if the UK becomes inward-looking, but then also the UK's contribution and influence to European aid. We see a risk there as well. And then very quickly, I'll end with this on tourism. We see this as an important channel since small countries like the Gambia, Kenya, South Africa, among others, the UK accounts for an important share of their market. Remittances, of course, and you just mentioned what has happened to sterling, which is wiped out to some extent the value of the remittances. So let me stop here. I'm sure we'll be coming back to these same issues.
Maybe let me just ask you before we move on. These are very early days, I know, but in terms of the sort of policy responses that we're starting to see across the region, I mean, could you just give us a sense of what adjustment measures governments are likely to put in place?
Well, two things. Firstly, African governments do recognize that there's been a need to diversify their various economic partnerships. And actually, this has been ongoing, as you know, with emerging economies playing a greater role in Africa. The other aspect, of course, is on boosting intra-African trade and investment flows, and there is a huge agenda on that as well. And I hope I could come back to that to illustrate some ways in which there is an opportunity, but also a risk on that agenda as well for the UK.
Okay, thank you. Vicky, David mentioned the aid part of the equation, which I know is something that you've been thinking about. So maybe if you just outline some of your initial thoughts on the potential impacts on development assistance.
Sure. I mean, as you rightly said, there are going to be repercussions on economic growth. I mean, of course, what we have seen in terms of aid from the UK is that as a percentage of GDP, it has been going up. It was a Lib Dem policy, which was introduced during the coalition government. And if you look at the way it's moved from 0.5% of GDP in 2011 to about 7.7% of GDP, and amounting to about £12 billion last year. I mean, that's quite good news. And of course, there are very few other countries that are at that level. In fact, we almost lead the pack alongside a few others. But the question, of course, is what's going to happen to that? Let's assume it stays at 0.7%. Obviously, if you have a lower GDP growth, it's going to be less than it would otherwise have been. So let's just look at it from a benign point of view. The best that you can say is that it's not going to be as large as people had expected. And that, of course, has all sorts of implications in terms of any of the programs that had been planned and so on. The second thing, of course, is that we could, in fact, see a decline. And if that is the case, then obviously, if it stays at that percent of GDP, it will be less than it will actually be going down rather than going up. So that's the next thing. The third thing is that, of course, in terms of what it buys, it will be less. Because, of course, the pound, unless it suddenly miraculously starts going up again to the extent that it breaks yet another record in terms of the rise that it may have, which is very unlikely given that we're going to see more cuts in interest rates coming up, so the differential interest rate with others will widen, although the US, of course, is not going to raise it now, but there we go. Nevertheless, I mean, what it does mean is that what it buys is less than it would otherwise be, and also the cost of whatever it is that it provides will be going up. So all these things are very negative. So that's the sort of economic side, if you like. And then, of course, you've got the political aspect, which is linked to economics. Yes, of course, we have already seen from the current Chancellor anyway, and from Theresa May, but who knows what's going to happen. We now have Theresa May and Andrea Leadsom, who seem to be the two who are going forward. But certainly from Theresa May and George Osborne, that the budget surplus that we're expected by 2019-20 is no longer going to be something where we're pushing for. But what it does mean is that we're going to be having considerably bigger deficits. Now, given that we made such a big fuss about this 8 billion that you mentioned, of course, well, we're spending 12 billion in overseas aid. Of course, there will be political tensions. Can we still afford it? Should we be redirecting? And you know that the UKIP demand was that it should go down to 0.2%. It's not going to be very popular because people like the feeling of being able to help. And frankly, to a considerable extent, it's sort of paper money in a way. You know, the Bank of England is about to spend 250 billion, if necessary, to support the banking system. Well, what is 12 billion out of that? But nevertheless, it will be looked at. And that of course, puts it all under serious threat. So we have to be aware, and perhaps we can talk about the consequences of that. There is, of course, an extra element, which is what do we do if we really do leave the EU in terms of all the projects that we're doing jointly? Because, of course, 40% of all the aid goes through multilateral organizations. Yes, of course, individual countries in the EU take responsibility for various things. And that's pretty good because we're quite strong in various areas and we lead various of these projects. But there are some areas which are really interesting. And when I used to work for the government myself, I had actually gone to sign on behalf of the UK yet another of that trade deals with the EU Mediterranean zone, which is actually very important. Yes, of course, we've got problems because right now these trade agreements don't really work with Libya, which have been suspended, and with Syria. But certainly, if you look at the whole Mediterranean, it's a very, very important part of the world where we are establishing a sort of free trade zone. They're not necessarily still doing it between them, but certainly we have been encouraging the access to Europe. What's going to happen with all that? And it wasn't just goods. It's aimed to be moving towards services increasingly, but also a lot of what we do is to do technical assistance with corporate governance issues and so on, which we've been focusing on. So there is a big question mark about those particular projects, which might, obviously that will affect the various countries, but also the uncertainty that it leaves us with in terms of really what can we focus on in the future.
Okay. Vicky, maybe just before I go on to Mohammed, because you raised there's a financial aspect to this, but there's also a political aspect, and we're going to see slower growth. We're going to see more pressure on the fiscal side, and there are certainly going to be people who are arguing, now is the time to squeeze the parts of the budgets that are politically squeezable, and aid, I would have thought, fit into that category. Yeah. But I just wondered what your perspective, now that we have a sort of slightly clearer picture of who the next Prime Minister is likely to be, what you think the prospects are of us seeing, a concerted drive to cut the aid budget.
Well, I think everything will be under scrutiny without any doubt. Although I think we are going to have a reflationary budget, without because otherwise the experts will be proven right. You see, which will be a bit of a problem. So we need to do something to get the economy working again. But I think everything will be looked at, and will be looked at very carefully by the Treasury, because the real problem is all these things are not free. Reducing interest rates to zero means less profitability for the banks. It means less money for savers. It means weaker pound. You've seen your Evening Standard front page. We heard about tourism saying it's going to cost you an extra 200 quid, and counting. Basically, to go I didn't read the details of where Is it my Greek trip next week? I mean, I don't know whether that is the one. But I think we've been downgraded and will be downgraded again. Yes, the markets at present are quite prepared to buy government bonds, and so yields are very low, so we can borrow relatively cheaply. But how long that will last, one doesn't know. But I think there is a serious threat, in my view.
Okay. Thanks. Mohammed, if I could come on to you. One of the arguments that was widely used during the debate by the Leave camp, including by someone who until recently was a prime ministerial candidate, was that Brexit would be good for the Commonwealth or good for building a new type of trading relationship that was focused more on the Commonwealth, less on the European Union. I'm not sure if they ever checked in with the Commonwealth Secretariat or discussed that with anybody in the Commonwealth, but I just wondered, maybe if you could give us a Commonwealth perspective on that.
Sure. Kevin, thanks. And first of all, thank you very much for the invitation. Before responding to your query, if you would allow me, I would like to make a general point, just to highlight the importance of this Brexit event and how the global community is going to address it. As you all know, last year we had these Sustainable Development Goals adopted by the international community. And Brexit shock has come quite an interesting time when there has been a lot of emphasis given on international trade as an engine or kind of supporting development in many of the LDCs, least developed countries, and Africa. On the other hand, what we are seeing that the growth of trade, even irrespective of Brexit, has been subdued. In fact, we all know the figures. Huh? If you think about the long-run international trade growth between 1980 and 2000, that rate was 7% per annum. If you think about what has happened over the past 6 years, that is only 3%. And this is quite unprecedented in nature by the history of our recent times, over the 7 or 8 decades. That never happened. So we are living at a time where already the trade growth rate was really, really feeble, weak, and now we're getting into another round of uncertainty caused by this Brexit. I think that point is extremely important. And also what is important is this. If you think about LDCs, I have done some back of the envelope calculation, very rough, because the research is now being undertaken. If you think about the composition of exports, that is concerned of many of our member states in Africa and in least developed countries. These days, we all talk about development with structural transformation. So forget about commodity dependence, whether we can move into the next phase, something on manufacturing. In that way, I have got a feeling perhaps UK's imports from least developed countries or sub-Saharan African countries a bit more diversified compared to other country groups that we are aware of. Like, there is a reference to Bangladesh and Cambodia. They largely export textiles and clothing. And they are already experiencing the shock because as the pound is falling down, and there is some estimate by ODI, that 10% devaluation could lead to close to 400 million worth of export losses. So that is one dimension. But also think about the other way around. The pound has lost value, so in that way, the imports here will be more expensive. And just today, I think there was a figure, I think yesterday, for Marks & Spencer, the sales figure has gone down by 8%. Now, what they are procuring all their, most of their materials, many of them from developing countries. And again, I think countries like Bangladesh, Cambodia, those particularly export textile and clothing to the UK will see the consequences. Kevin, now coming back to your question on the Commonwealth issues, I'm sure that this has been, at least in some people's mind that if Brexit happens, then the UK will have its policy sovereignty and thereby, going for the Commonwealth-wide some kind of trading arrangements will be of great value. But to be honest, the way we say this is that, of course, many people can see the opportunity in that, but there are tremendous challenges of thinking about that kind of trading bloc. Because Cyprus and Malta, two other Commonwealth countries, they are still part of the Commonwealth. And that means a Commonwealth-wide FTA, for the same reason when UK was the part of the European Union, will be quite difficult. That's one issue. The second issue is, if you look at the Commonwealth is nothing. It's just a microcosm of a wider global community. And we have got all different types of members, at different levels of development. So with that kind of situation, negotiating a trade deals is just like something as difficult as under the WTO. And that's why we'll see, it can go on and for a long time. In contrast, the real advantage of the Commonwealth was that, we can promote our trade based on our historical ties, the great advantage of the language English. And in recent times, we have estimated, that would give the Commonwealth members a 19% cost advantage already. It is in our flagship trade publication report that we launched last year, Commonwealth Heads of Government meeting in Malta. So that advantage is already there. We did not have to, go through an FTA or trading bloc kind of arrangement. So my view is, of course, one can see the possibility, but I see there are going to be enormous challenges as well.
Okay, thank you, Mohammed. Phyllis, I already mentioned the currency effects, and these are clearly, they're probably not short-term, and they probably are going to have long-term real economy effects in emerging markets. Could you maybe just talk us through some of your initial thinking on that?
Yes, sure. Frankly, estimates that we've seen in the run-up to the Brexit vote were a fall in sterling of anywhere between 10 and 30%. In trade-weighted terms. We've seen about 12%. But I think, in the work we've just done on this paper we've just published, there's two key pathways, and one is the exchange rate on trade, aid, and remittances. And the second pathway is financial markets themselves. When it comes to the currency, so just the 10% devaluation we've seen, it actually can be quite detrimental for trade, aid, and remittances. So $1.4 billion loss in remittances, $1.9 billion reduction in aid, and $500 million export revenue hit for developing countries, for LDCs, actually. So that's a $3.8 billion loss just from the 10% devaluation. So sterling continues to fall. That's the key risk, and I think it stands to be quite calamitous, actually, for growth prospects. In terms of the second channel, I think it's equally as significant. In the wake of the vote, we saw $3 trillion lost in 3 days. We've seen some stabilization after that. But given the level of economic uncertainty, of political uncertainty, I think we can assume that the volatility is going to continue. And that's the thing that's really detrimental for growth prospects, because we see lesser developed countries really take a hit on their investment in that situation and their longer-term growth path. So those are the two. We actually go through quite a few pathways, but those are the two that I think are, in the short term at least, are quite significant.
Could you maybe just say a little bit more about some of the emerging market currency effects that we've seen so far?
So on the day after the vote, the South African rand hit a record low against the yen. Effectively, what we're seeing is risk aversion. So the markets are generally going for safe haven assets, gold, U.S. government bonds, the Japanese yen. And it's this particular risk-averse scenario where the countries that we care about suffer, because there's a reversal of investment flows. And so in that context, you saw the countries that actually have strong trade relationships with the UK really struggle. So South Africa, India, Nigeria. The Central Bank of India intervened to support their currency. You saw several central banks intervening to support their currencies. So I guess our worry is that if this continues, you'll see not only currency weakness, but currency volatility. And that, over the longer term, really does have detrimental investment and growth impacts. It throws any long-term plans off course in the developing world.
Thank you. Okay, so there are two planted questions. I was going to say expert questions. They are experts, but the questions are also planted. One from contribution stroke questions from Max Mendez Parra, who with Phyllis and my colleague Dirk Willem Terveld produced the briefing paper that Phyllis referred to, which please do pick up. It's right outside. So Max, over to you.
Thank you. My question is more to the long-term effects in terms of particularly trade. There is the was in many of the Brexiteers that the EU is. Sorry, I'm going to repeat the question for the microphone. This is more associated with long-term effects on trade with developing countries. There was on the Brexiters the idea of trying to impose that the EU was very protectionist, so there might be a pressure actually to have very open trade regime, and that means low, most favorable nation tariff. What would be that scenario? That is a scenario where actually the UK is out of the of any kind of customs union with the EU. What would be the implications, particularly for less developed countries in Africa and the Commonwealth, of the fact that they will be affecting in terms of their preference margins?
Thank you. And Lucia Fry, who's head of policy at ActionAid.
Yeah, I was just going to broaden the discussion out a little bit, actually, to ask the panel to reflect a bit on the impacts of Brexit on the kind of global political economy, because as anybody who's been in any of the big international meetings over the last 15 years, they'll have observed that the UK has enormous political heft in a lot of these discussions, and that has largely been in a progressive direction. I'm thinking of things like the leadership role it's played on climate, tax transparency, corruption, and the leverage it's used with its aid budget on various important issues like women's rights, nutrition, and so on. So I was wondering if you'd like to reflect on what we're likely to see is, I suppose, a less sort of muscular UK on the international stage, both because we'll be more inward-looking, we'll be preoccupied with the terms of Brexit and possible weakening of support to 0.7, as Vicky said. So I wondered if you'd like to reflect on that a little bit and what that means for development cooperation globally. And then just another sort of observation, really, to throw out there. If, like me, you've been spending a lot of time reading, watching, trying to learn about the motivations of those who voted leave over the last couple of weeks, you might have noticed the same thing, which is that the concerns that they voice when given a chance, when they're not being called stupid, which we mustn't do, is what they want are decent jobs, good public services, opportunities for their families, life chances for their children, and sort of bearing in mind the universality of the Sustainable Development Goals, I just wonder whether there's a little opportunity there for trying to bridge the notion of development cooperation into our own community.
Okay, so they're really great questions to get the ball rolling. Actually, you've got the short straw, so you're going to get the first one. And I mean, I know the work on this must be in its very early stages, but clearly the preferences issue does have very serious ramifications for Africa, and in particular on the EU trade partnership side. So maybe if you could respond to that part of the question.
Sure. Yeah. Actually, on the preferences, our view would be, and this is supported by the research we've been doing, is that the preferences have been eroding anyway. I think this is the trend that we have seen. And in any event, the mega-regional agreements that are not quite in force yet, but we know the direction that they've been going, in particular the TPP, the RCEP, that's the Regional Comprehensive Economic agreement among the Asian countries. Very clearly, the direction is preference erosion. What we've been arguing for at the Africa Trade Policy Center is actually more flexible rules of origin that would allow for a greater accumulation between African countries and even between African countries and other partners. And we've seen how this has worked in the context of AGOA with the US. When the US allowed for greater accumulation in textile and clothing production, We saw the exports from countries like Lesotho, etc., just rocketed. So we've been advocating for reform of the rules of origin in preferential arrangements, and I think there's an opportunity here in how the UK would structure its relations with poor countries. I think the rules of origin is what it will be key, not so much preference erosion.
Okay, thank you. Mohammed, if you want, add something on that, but I'd also like you just to get the ball rolling on one of the two wider questions that Lucia asked, which is on the role of the UK in international cooperation. And does this signal, if you like, a diminished role looking ahead?
Sure. I would like to address both the questions in a brief way. First of all, it's true. I mean, economists probably we are better in predicting things on a more long-term basis. I mean, short-term fluctuation and volatility. Although, I mean, they can put things, as my colleague here said, that, we'll put things, of course. But having said that, I mean, I also want to be objective here. The fact is, now UK has got tremendous opportunity as well to undertake some of the things that will actually benefit or will be seen as an improvement of the existing mechanism. David has given one example of this rules of origin issue. Here, if you think about the standard mechanism that exists in the globally, then the European Union, they follow more complicated rules of origin procedure. On the other hand, many people think the Australian and the Canadian approach of just about 25% value added and you get duty-free quota-free market access, that is by far the best possible mechanism for supporting countries. And if UK is going to get back its policy sovereignty, I think that's an important route that you could take. Also, Max, the issue is think about the common agriculture policy. I believe the UK is going to be a country that would be able to, I hope so, to get rid of some of the issues there, and that will tremendously help some of the African countries, but also at the same time will set example, like what could be a development-friendly trade policy regime. The other issue is think about, despite all the struggles that we have seen in the post-financial crisis global economic environment, the UK has achieved the UN target of 0.7% of its national income as foreign aid. Now that tells a lot of things. I mean, if UK is going to be committed, despite the fact that there is going to be some loss of clout as it was having under the European Union, but I do believe there will be other people in the room to support UK, the whole Sub-Saharan Africa, LDC group, ACP countries, and many of the Commonwealth developing countries. So I do not fully rule out that it will be a total loss in terms of UK's exerting influence. Thank you.
Thank you. Vicky, I wanted to ask you what, it's probably, I think, a really good question, but it does go slightly beyond how we'd frame the discussion, which is about the implications of the vote for the UK. There's the phrase in the new Sustainable Development Goals of leave no one behind. It's basically people who are being left behind in the UK voted en masse to leave. And I just wondered, what the point that Lucia was making about the universality of that commitment, and does it have a greater resonance than ever really in our own backyard?
Obviously one has to take it into account why people voted the way they did, and it was a protest vote, and quite a lot of people have been left behind, and obviously there's been a regional rebalancing or anything like that. However, I think we're likely to have a government which is more right-wing than what we just had. So I wouldn't have huge hopes in that respect. And frankly, if you have low growth, that will just get worse for all these people. And at some point, they will perhaps think differently. We've already seen, and I'm not necessarily advocating it, but certainly an Evening Standard opinion poll which suggested just a couple of days ago, maybe it was yesterday, that a third of the Leavers will now vote to stay. But who knows what would happen if it were. But I don't think that you can improve the condition of people by having a recession in the economy.
It's hard to argue with that. Phyllis, do you want? Maybe just give us your take on the international cooperation question, because I do think this is a really key area actually, because the UK has played a leadership role over many years, both on development assistance, but also more broadly on the Sustainable Development Goals and in other areas. Just how you view the future.
It's an interesting thing in terms of the UK's role in the global macroeconomy. As China liberalizes its economy and many other emerging countries become bigger and emerge, UK was a destination for that sort of collaboration and investment. And in the aftermath of the UK's vote, plans for China to issue renminbi bonds, to develop these types of collaborations have been delayed. So this type of uncertainty, I think, at least from an economic and a financial perspective, is going to be quite detrimental for the UK's role as a sort of a cohesive force.
Okay. Thank you. Okay, so at this point, I really want to throw it open to you guys. I'll take, there are microphones scattered liberally around the room. So I'm going to take questions in groups of 2 or 3.